In the first part, we talked about chart patterns. By the end of this lecture, you'll be able to identify the 3-day cycle as well as taking entries from the reversals. If you missed the first lecture, we advise to start there so that you fully comprehend the concepts that we discussed. But before we go through, make sure you subscribe to this channel so that you won't miss any part of this YouTube mentorship program. So by the end of this lecture, you'll be able to draw and identify reversal points like these examples. In this case, it was euro against dollar. We anticipated to see a reversal at this point, and this was its after. As you can see, we had the anticipated pattern, and the market went our direction. We had also another example, which was actually done in September. We had this anticipated to see the market move from this point going to that zone as our target, and this was its after the market actually surpassed our target. So if you stick up to the end of this lecture, you will learn how to identify these points. So in this lecture, we are going to discuss what is the 3-day cycle, how to count levels in a simplified way, reversals, trading strategy, market examples, and a very important discussion at the end of the video. So all tradable assets follows the rule of reversing after a 3-day push up or down. We mean after 3 days of rise or 3 days of drop, we expect to see a market reversal. However, a net day of rise or drop is what we call a level. By net, we are saying a day that breaks the high of yesterday or the high of the previous day is what we call a level. So this is the same principle from where the Elliott wave theory was derived. I'm sure the Elliott wave is actually a common trading method amongst today's modern traders. Therefore, we can safely say that after 3 days of net rise, we reverse or vice versa, as shown below. In this case, we had level 1, which is a day of rise. As you can see, level 2 is actually breaking the low of this first level, and we can see the third day is also breaking the low of level 2. It's something that you should always watch out so that you count these levels properly. So to summarize everything that we said a day of drop or a day of rise is what we call a level, and that level should actually break the low of the previous day or previous level. So let's go over the charts to actually learn how to count levels in a simplified way and learn how to trade off reversal points and have the most important notes. So this is euro against JPY. We are going to use this for illustration. So the first thing is to actually locate any double top or double bottom that you can see. In this case, we can say that is the initial point of levels counting. So from this point, this was in September, and I'm going to use this as my data or my point of reference or my starting point. I'm going to count net days of drop, not just a day of drop, but net, whereby we can see a clear impulsive drop or rise. So I'm going to use rectangles to mark these days. We can see that from this particular point going down, we had an impulsive drop. However, on this day, can we see a net day of drop? No. On this day, no, no, no. And on this day, there was a net day of drop. We can see the market actually breaking the low of the previous net day of drop. However, the market came back, cleared off this particular impulse. Therefore, this was now part of the consolidation phase, right? On this particular day where we had a spike to the upside, can we see an impulsive drop or a net day of drop? Yes, there was a drop. So we can actually mark that drop as a level, right? From this point, it was a net day of drop that broke the low of the previous day, right? So we had level 1, level 2. From there, can we see another net day of drop? We can see a clear impulsive drop that broke the low of the previous level, right? We had this is a net day of drop, and at level 3, as I've said earlier, that is where we expect to see reversal. So connecting the first lecture of our YouTube mentorship, we said at the level 3, that is when we apply the reversal chart pattern, and we learned about the double bottoms and the double tops. This is where we now apply it. We can see that we had first leg and then second leg to actually make our entry. In this particular lecture or particular level for this mentorship, we are not yet talking about targets and where to put your stop loss. We are only emphasizing on where to make your market moves. So from there, we can start again to count these levels, since we are actually following the 3-day cycle. We had the first rise, right? The second day of rise that broke the high of the previous level. So in this case, we were expecting to see the third rise, right? So the high of this particular level is at this point. Someone may say, can I count this as a level? The answer to that is no, because we did not break the high of the previous level. From there, we had the third day of rise. After that, we can see first leg, second leg, and make our entry. A reversal pattern has been issued and the market went our way, right? We start again to make our count. So these cycles comes in different sizes and forms. We can see that on this particular cycle, it was a long move, and on this one, it was a short move. However, in the next cycle, we will see that the cycle was small. We had a day of drop and pullback, then another day of drop that broke the low of this first day, right? Like this. Then the last impulsive day of drop, we can see there was a small consolidation and an impulsive drop that broke the low of the previous level, making it a complete 3-day cycle. On that completed 3-day cycle, we had first leg and second leg to actually make our move. As you can see, the market is going in our direction, and we start again the count, right? Like that, we keep on doing that, trading off the end of the 3-day cycle and actually repeating. And it doesn't mean that you're not going to lose, but you are going to lose less than the number of times you are going to win. And as always, trading will require you to be highly patient for all these to work out, and you need to also be consistent in the way that you are going to be approaching the market. The times you wake up and count these levels, the pairs that you are going to create as your watch list on a daily basis, that is how you get paid in trading. So these levels can also be enhanced. You can actually start to incorporate higher time frames to know where the market will go in the long term, and actually be able to hold trades. Imagine someone could actually hold a trade that he entered at this point, and you would see the market keep on rising, going in your direction. On that note, we come to the end of this video. Check out our free Telegram channel where we share setups like these ones on a daily basis. See you on the next lecture.